I kind of want to talk, so I'm going to ask myself a question quick. It says VFC just reported thoughts. I mean, we don't have a call on VFC per se, but I think it's the way and the timing of VFC. It's kind of right at the start of earnings season, and it's one of those companies that's a bellwether, got great brands, pretty great management, multinational exposure, and I guess kind of from 30,000 feet, without being in the weeds on VFC, I think the conclusion here is things aren't getting better. I mean, that's pretty obvious. If you look at it, earnings were down 9%, but I think the key point is that you're comping on top of easy numbers, very, very easy numbers. So what we look at every time when we go through numbers is the algorithm. So what did sales grow? How did that transfer into margins? And what was the ultimate, earnings growth rate, and then cash flow on top of that. So ideally, you'd have, let's say, 1% earnings growth, 2% gross profit growth, 3% EBIT growth, 4% earnings growth, and 5% cash from operations growth, right?
Yeah.
It's just like the perfect. I don't even know. What's a 5? I can't think of the word, but that'd be the perfect algorithm. And I think what you had last year for VF is you had sales up maybe 2-3%. Margins down. I think you had a little kick in earnings, maybe from the tax rate or share buybacks. But now, you have flat sales and earnings down 9%. So the easy comp argument is completely out the window.
Yeah, that's a good point. I mean, so that's kind of what we go back and forth with people on. Well, in Q3 and Q4, we're coming up on easy comps in a lot of these sectors. And I mean, from our standpoint, we look at the macro overlay, and we're looking at the consumer that kind of peaked on a year-over-year rate of change basis back in the first half of 2015. You have consumer confidence that always peaked. Operating margins peaked for companies that are coming down. And then one of the topics that we're really looking at now is consumer credit growth.
Right.
And it's a very simple concept. If you can borrow $105,000 and you make $100,000, you can spend more than you earn, and as long as credit growth is expanding, it doesn't matter if wage growth is going nowhere. You can ultimately continue to spend more than you make as long as that's expanding. And I think that we're starting to see signs of that could potentially roll over. Although it's very robust, it's depending on what you're looking at, it's different. But I think if you really think that if you're looking at just potentially easy comps, I think that you have to look at more than that, like you were saying. I
think with VF too, I'll touch on that, and then the credit part of what you just said. But
yeah, you probably know some of them.
Yeah, so on VF, I mean, what you have is you've had currency that's been a headwind for the better part of 18 months. In this quarter, earnings were down 9%. On a constant currency basis, they were down 6%. So, I mean, you're not getting that snapback from currency, although the headwind is kind of fading. And the other part is that, like you said, that I think it was slide 2 in the deck, in the key points is just these kind of outlandish expectations in third quarter, fourth quarter, and then it gets even more aggressive in the first half of 2017. I mean, you're seeing that across all of retail. You saw it last year, and I think that was one of kind of the key themes that we kept calling out. But these numbers aren't getting better. And VF is obviously an exceptionally run company.
Yeah.
Obviously our opinion, but they're not getting better. So, and then on the consumer credit side, I mean, this is obviously something that we as a firm have been talking about for a long time. Just as it comes to retail, I think the key names to focus on there would be one, Kohl's, which has about 60% of its sales on a credit card, and 30% of its EBIT is through the transaction is accounted for on the credit card. So it's kind of just the cycle through the cap 1 and all the way back up, but it's 30% of their EBIT. So there's tremendous downside if you look at, say, like 08 to now, when the market's corrected in 08. I think they had exposure, like, let's say 10% of their EBIT and 20% of their sales were on the credit card. Those are rough numbers. I have the exact ones, but they're just not stored away in my head. But now here you are, you have 60% of your sales, 30% of your EBIT tied to a credit card, and you're also levered to the U.S. consumer. So you get a leg down on the U.S. consumer, and then that credit cycle snaps, and you get double whammy.
Yeah.
So I mean, you have that with Kohl's, you have that with Macy's, JCPenney, Gap to a certain extent. There's a few other names, but the department stores are particularly levered.